Okay, let's start the meeting. That's what I wanted to do. It is 6:29, and that's a minute or two before the official start time, but now it's 6:30. So here you go. This is the Homebuyer Webby that we do weekly. We do this every Tuesday evening at 6:30. We started doing this the first year, and I'll be honest with you, the first group of webinars that I did were full of technical issues that made them pretty much unworthy to be up on the web and be at least to hold anybody's attention. So I've tried to tweak them to make them a little more concise. Try to do them a little bit shorter so that there's time for you to ask questions. And I want to thank you all for showing up. Welcome. We will hold the questions till the end. We'll go through the presentation. Hopefully it'll be informational to you and helpful. So this one is, let's see, it is October the 18th. Remember the date this time, 2016. It's what first-time home buyers need to know about their credit, and particularly their credit scores. And I also want to state that what you don't know can hurt you. I talk to people every day that seem like they have gone through some steps to help improve their credit to one degree or another, and in many times the repairing credit or fixing credit or making your credit better is not really very intuitive. Matter of fact, it's fraught with all kinds of pitfalls, and what you want to do is you want to try to avoid those and talk to somebody that knows what they're talking about. I'm one of those guys, but there are others. There are a lot of guys out there that study this and know what they're talking about. So with that, I'm going to go to slide number 2, which is my introduction slide. And I call myself the Kingwood Mortgage Guy. Why is that? Well, I'm in Kingwood. I've been doing this for a long time. I like the fact that I got there first, so I've decided I'm the Kingwood Mortgage Guy. This tells you a couple different ways that you can get in touch with me. Obviously, my Kingwood Mortgage Guys site is kingwoodmortgageguys.com. Also, we're putting all the recordings that we do on homebuyerwebby.com so that it's going to grow to be hopefully a real valuable resource for people that are just looking and have a lot of questions. And what I find most of the time is the people that are starting to buy, they don't even know the right questions to ask, and that might be you. So this is going to give you some kind of basis to at least ask intelligent questions, because if you don't know what to ask, guess what? You don't get the information you need. So we want to do that. My email is mikekmg@gmail.com. I want you to feel comfortable to send me any kind of questions, and then obviously best way to answer those questions is over the phone, but we can do the little ones or simple ones via email. And then finally, my phone number is 281-348-9899. I am licensed by the state of Texas. It's my NMLS number 318989. So here's what we're going to cover tonight. This is what I like to do. I'd like to kind of give you a chance to see that you're in the right place. We're going to show you what a credit report looks like. We're going to talk about credit scores. We're going to talk about credit history. We're going to talk about credit accounts. And then we're going to talk about the mortgage guidelines for the 3 primary loan programs that are out there: conventional, FHA, and VA. So what you're going to learn tonight is this information, and then if you want to stick around afterwards, after we get started, I'll stay here as long as you have questions to answer. So we'll get started right now. Okay, this is what a credit report looks like. Now, I will tell you this is an old credit report, but I wanted to get you familiar with it, and obviously I took some information out so that you wouldn't be able to bust whoever it is that this credit report belonged to. But there's a couple of things that are important on here. Obviously, you have the creditor. In this particular case, this guy has a mortgage with option 1. He has a Washington Mutual. This looks like it's a credit card. It says right there, it's a credit card. USAA account, First Community Credit Union account, USAA federal account. And then after you look at the general part, it's a little complicated, but there's a lot of good information in here. It tells you the date that it's opened, the last date it reported, what the balance was, how many months it's been reviewed. It's kind of interesting. It tells you the dates that you've been late. Have you been 30 days late? Well, he's evidently had some late pays. Tells what his payment is, what his balance is. So there's a terrific amount of information that you can get from a credit report, and we use this information to determine if you are going to be deemed credit worthy. The mortgage entities have I like to describe it as a bucket. The conventional bucket is a little bit smaller than an FHA or VA bucket, but it's still a bucket, and anything that fits inside that bucket will generally get approved. And one of the real fears that a lot of people have is, oh my gosh, they're going to review my information and they're going to turn me down. And it doesn't happen very often that a mortgage person will initiate the process and go through the process because there's no reason in the world for him to continue or her to continue in this process if your criteria doesn't fit in the bucket. And credit scores and the way that you handle your credit, your creditors, is a big part of that. It's one of the big things. Obviously, it's credit, it's your income, the stability of your income, and they like to say the integrity of the way that you've handled your credit in the past. Those are things that are important to it. So I'll get on to a little more of this in just a minute, but I always thought it was kind of interesting for people to look at a credit report. So what is credit scoring? This is the second part we're going to talk about, and I'm going to read this. It says the use of a statistical risk assessment model, that's an algorithm, which uses consumer reporting agency information, so the way that each of the creditors reports to the agencies, to significantly increase the level of predictive power to determine good payers from bad payers. So if you're a creditor and somebody wants to borrow money from you, it'd be good for you to know if the people that were wanting to borrow money from you were good payers or bad payers. And you can see on the chart down below, it's got a scale that in the green and light green, it says excellent credit. That means they're good payers. It's got good credit. They are good payers also. Bad credit is determined, and it's kind of like the beauty is in the eye of the beholder. Some people on this chart that are considered bad credit for another program or for another set of eyes might be good credit. And then you see the thing that all credit card companies fear the most is bankruptcy. So this is, I think, a good depiction, but I'm going to be a little more refined here. We're going to talk about specifics because some of the different bureaus, or not the bureaus, some of the different lenders and the types of programs that they run, whether it's conventional, FHA or VA, have different criteria. And what's good for somebody might be bad for somebody else. That's what I wanted you to see. Okay, so we'll move on. So what is a credit scoring? So kind of in that same flavor we just had, now I've put some numbers to it. And you can see if your FICO score, this is a FICO score, this is not the consumer credit scores that is so easy to get. There is, just an FYI, there's a big difference between a Vantage score and what the mortgage industry use for credit scoring. For that matter, there's also a difference in what the credit reports and the credit scoring that's used by car dealers is different than what a mortgage company would use. And the reason is because they're different entities. We don't look at all the same criteria, and they're going to be different. So excellent credit, if you're 760 or above, you are excellent. 700 to 759, I mean, that's very good, very good. 723, that's what they're telling us right here, is that's the median FICO score. That means that most, or the people, that's right in the middle of where people go. That's what a medium income or medium FICO score means. 660 to 699 is still considered good. 687 is an average FICO score. And there's a whole thing we could talk about the difference between medium and average, but it's somewhere between 687 and 723, so that should give you a good idea. Now, on this chart, it says from 620 to 659 is not good. Well, again, beauty's in the eye of the beholder. 580 to 619 is poor. And then finally, 500 to 579 is very poor. And what we're going to find here is that this scale is inconsistent with the way that the mortgage credit criteria is for some of the major lenders out there. FHA, where if you're in the 620 to 659, that's pretty darn good. I mean, you can get a loan there. If you're in the 580 to 619, it's not great, but we can still get a loan in most cases between those two ranges, assuming that you can jump through some of the hoops that you have. So let's go on to the next one and see what we have. All right, so on this one, what I wanted to talk about is the credit history. And the history, a couple things about the credit history. Obviously, it's going to show here in this particular case that they have 6 lates. It will usually tell you the exact date that you're late, going back 2 years. And there's a reason they only show 2 years, is because those are really the only criteria that affects the scoring mechanism. I was talking to somebody today that had some negative credit 6 and 7 years ago, and they were getting ready to do some things that would affect those credit scores from 6 or 7 years ago. And I told her, I said, don't mess with that stuff that's that old, because it really is not going to help anything. It doesn't hurt you and it doesn't help you. So I would avoid doing anything with that. Anything that's older than 2 years, just leave it alone. There's nothing you can do to help it right now unless you're going to pay it off. And I mean, I would be one of the first ones that if you owe the money, then you should do the right thing. I mean, if you owe the money, you ought to pay it. But if we're trying to get your mortgage done and we're trying to get your credit scores up, it might be the use of that money is better served in another place. So that's what I'm going to say about that. And the other thing is, it tells, on this credit report, it tells the last active, but we pay a lot of attention to this last active or the date of last activity. And the reason we do that is because we want to see how current that is. But that usually has a bigger effect on accounts that are in collection. But what you can see here is that it tells how many months are left. I think it should. It tells when it was past due or how much it's past due, and the list of the accounts that you've got open and how much your debt ratio is. So all of this information comes from the credit bureau. It tells what the high limit is. If it's a revolving card, it tells if you're over that limit. And those are all things that we look at to make determinations on whether this is going to be a valid, would fit into the mortgage box of the entity that you're trying to qualify for. All right, credit accounts. Credit accounts, I'm going to go back for this one here. They're classified in a couple different ways. This is a mortgage account, okay? So it says mortgage right there. This is credit cards. A revolving account is like that. And then on these, this looks like a car loan. It tells you right there it's an installment account. So those three are the main ones. Is that you, and another one today that's very prevalent is student loans. Back in this day, there weren't so much. But so you really have revolving credit cards, you have mortgage debt, you have installment debt, and then you have student loans. Those are the ones that we look at. Now it's kind of interesting. The one that we can use to affect your mortgage, your credit score the best is the revolving cards. And I go through a lot of that. And if you go to homebuyerwebby.com and you look at the credit tab, there's a couple on there on the way that we use secure cards, and then it goes through the whole story, so I'm not going to waste your time with that now. But the reason I put these on there is because credit cards are the most important. They affect your credit more than anything else, and how you handle them. Well, just today, again, I found that one of my borrowers that's in the process of getting a refinance in this particular case, we had to re-pull his credit, and it turned out that in August he made a payment that was late on his credit card. And I think it was like a $54 bill. It wasn't that he couldn't make it. He makes plenty of money. But he was too busy, or I don't know what happened, but it turned out that the fact that he didn't make that credit card payment, his credit score dropped 47 points. And in his case, that kind of knocked him out of the program that we were trying to refinance him with. So paying the bills, paying the credit accounts on a consistent basis is a huge thing. And just in general, mortgage companies do not want to see any late payments in the last 12 months. If they see any late payments in the last 12 months, it causes them concern. They worry about that kind of stuff, because if you're rallying, if you kind of gathered yourself together, you're on top of things, you're making money, you're starting to save a little money, all those things are good, and then you fall back and you make a late payment, there's some concern that you may not have it together. And the last thing that the lenders want to do these days is to lend money to people that can't pay their bills on time, don't have the ability or the willingness to pay their bills like they're supposed to. Here's a big question a lot of people ask me is, they think that if their credit's bad, it's bad forever. And the truth is that your score can change daily depending on what the input has been. So if the creditors, each of the creditors has a subscription to Equifax, Experian, or TransUnion. And what they do when they get new information, they report usually on a consistent basis. So if I'm a credit card company, every month at the month end, I'll report all my accounts to the credit reporting agency. Some report once a month, some report every other month, some report twice a month. I mean, each creditor has its own subscription of the time that they can report to their reporting agencies. And when that happens, when they report, it changes your credit score because the algorithm kicks in and looks at it all over again. And the algorithm is it's just a model that's set up that punishes you for doing certain things and rewards you for doing other things. And that is where you really want to know what those things are, because if you're going to be qualifying for a mortgage, you reap the benefits for having a high FICO score, or you have the consequence of having a higher rate if your credit scores are lower. So everything I can do to help you get your credit scores higher saves you money, and that's what I'm all about. So what I said in here is the score is a snapshot of a consumer's credit profile at that particular point in time. And when we make, there's a thing that we do called a rapid rescore. We can rapid rescore, and usually when I say rapid, it's 5 to 7 days before that takes effect. Sometimes faster, sometimes a little slower. But if we can change a balance, if I can encourage you to pay down a balance to a certain amount so that we get some points, that can make the difference between A, qualifying or not, or B, getting a better rate or not. So those are all important. And the key thing that I want you to understand is that it is dynamic and it can change pretty darn fast. Okay, so I did this. I'll go to the next one. All right, so now I'm on to conventional guidelines. This is a conventional loan is non-government. When I say non-government, it's kind of sort of government, but it's considered a private mortgage entity out there. And so what they have their own mechanism. If you remember that other one that I sent you before, it had different numbers on it. This is conventional numbers. 740 to 850, they're measuring risk. And if you're at 740 FICO score, they figure you're at no risk. They're at no risk by lending to you. At 720 to 739, you're a slight risk. Not much, but there's a slight risk there. At 700 to 719, there's a small risk. 680 to 699, medium risk. 660 to 679, a risk. And then 620 to 659. They'll make loans to you, but it has to be very specific. And really what I tell people when you're doing a conventional loan is you want to have a minimum of a 660. Now here's the rub. As your FICO score goes down, your credit score or your interest rate goes up. So obviously when you're in the 740, you get the best rates. As you drop from a 720 to a 739, the rate's not, I mean, it's pretty good, but it's not quite as good. And then each little 20 points down you go, the rate gets a little worse or goes a little higher. So it's just real important that you understand how sensitive these are. And if we're at 719, then our 699 is probably the big one. When you go from 700 to 699, we want to do everything we can to get your score up over 700 because it makes a difference on the rate. So hopefully that makes sense. And then FHA credit guidelines, well, this is a risk graph similar to the other one, but the numbers are different. The box is bigger, if you will. And if you're at 680 to 699, they don't consider that any risk whatsoever. If it's 660 to 679, slight risk. 640 to 659, small risk. 620 to 639, medium risk. 600 to 619, it's a risk, but they still do them. And then 580 to 599, huge risk, but under the right circumstance. And this usually means that you're putting more money down on a 580 to 599 score. Harder loan, definitely a harder loan. These are hard. When it gets to 620, that's when it's a very easy loan. So one of the things that I want you to take away from that is that the credit scores, a lot of people consider this bad. If you look back at one of our original charts, 620 to 639 was what somebody considered bad credit. Well, I mean, it's good for us, and the rates are decent too. So one thing I also note that the criteria for rates moving up and down, the interest rates for FHA loans are more aggressive or lower than conventional rates, particularly on the lower levels. So that's something that's a benefit or a positive for FHA. The negative is the way that they treat their upfront mortgage insurance premium program. But that's not for this time, that's for the next time. Okay? So again, I'm trying to scoot through these really fast. Each bureau scores are different. So Experian, TransUnion, and Equifax, they all use a little different algorithm tweak to make their scoring mechanisms. That's why you rarely have anybody that has all the same credit scores. They're usually a little bit off. Well, why don't their scores match? Well, it's because they use different algorithms. Which scores do you use? That's a good question. The one that we use in the mortgage industry is we use the middle one. And it's sometimes you'll have a 740, a 640, and a 540. And in that circumstance, we'd use the 640, the one that's in the middle. Now, that's a crazy example, but that's how it works. So we are looking for the middle score. Different industries, I mentioned earlier that the auto industry has a separate algorithm. What everybody tries to put an emphasis on, if you're like a Dillard's store and you have a credit card, well, guess what? You care how people pay other creditors that are similar to theirs. And in the mortgage industry, we care how you pay rent. That's similar to us. In the car business, then we look at how you paid your car bills in the past. Very important, because they want to see, it seems like people do the same thing over and over again. Different scoring models within the industry, there are those. There are some mortgage companies that have, this used to be prevalent, I don't know if it still is, to be honest with you, but each lender has the ability, particularly the large lenders, to tweak the algorithm a little bit, because the people that create the algorithms allow the industry giant to do that, so they can tweak their scores a little bit, and that helps them. So here's what we covered. That's pretty much the end of this presentation. I tried to keep it short tonight. What is it, 6:53? So we showed you what a credit report looks like. We talked about credit scores. We talked about credit history. We talked about the type of credit accounts. We looked at the credit guidelines for conventional mortgages, FHA mortgages, and VA mortgages. And I know I really glanced over all of this information. I mean, each one of these subjects I could probably talk another hour for, but I didn't want to. I wanted to tweak your interests. I would love for you to call me, and we can talk about your specific credit report. One of the things that we do here that may be a little different is when we do a pre-qualification, we'll pull your credit, we'll look at your documents, and we'll counsel you. And it doesn't cost anything. It's a total free. If you qualify, it's better. I mean, and you're not obligated to do your business with us if you don't want to. We'd love to hear from you, and we encourage you to call us. I think I'm going to put my phone number. That one? There you go. If you wanted to call me, that's the number to call me right there, 281-348-9899. Again, you can email me, or you can go to Homebuyer Webby and check that out, or you can go to my Kingwood Mortgage Guy site and check that out. If that's let's see, there's some questions on there. I think what I'm going to do, I'm going to stop the recording, and then I'm going to answer those questions. And I want to thank you for being on tonight, and I hope you have a great day. Talk to you soon. Bye-bye.